The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. This is Bobby Rains here for our periodic Investors Observer Members Only Workshop. Welcome. All right, this is our agenda for today. We're going to look at a few charts. We'll talk about what else is happening, look at the sectors and industries that are hot in the market right now. And then the rest is member-driven content, questions, bite demonstrations, stuff like that. As always, I can prepare slides for questions that are submitted ahead of time. Just mention it's something you'd like to see covered in the workshop, and I will get to it. Thank you for everybody who submitted questions ahead of time this time. If you didn't submit questions ahead of time, don't worry about it. You can go ahead and put questions in the box either now or as I'm talking, and I'll get to them either as we go or at the end, depending on how relevant it is to what I'm talking about in a moment. All right. Excuse me, let's get started. Okay, so this is 1 year on the S&P 500. Since the last time we talked, we've gone down a little bit and then back up some. We've got this kind of new resistance level here at, we'll call it 4818, somewhere a hair above 4800. And we'll talk a little bit about maybe some of the whys for some of this decline later. It generally has to do with, I think, the Fed mostly surprising markets, but also some Omicron stuff, maybe a little inflation stuff. But really, I think it's mostly about the Fed. All right, the Nasdaq looks similar. The big difference is the Nasdaq hasn't set a new high since, we'll call that the middle of November, whereas the S&P set a high, looks like when trading started again for 2022. So, and we'll look at some other stuff, some internals in the next couple of slides that'll give us a better picture of this. But the basic answer is tech was really hot for a pretty long time and has been less hot more recently. So that's that's kind of what's going on there. The Nasdaq certainly lost more ground from a technical perspective in terms of going below the 100-day moving average and below this support and resistance line here, which should be pretty strong. But in terms of where we are now, it's not really that much different. I guess it's still below the 50-day moving average, but it's moving in the right direction. And the Russell 2000 peaked actually even earlier than the Nasdaq and has obviously fallen a lot more since then. It kind of is the worst looking of the major indices that we're going to talk about here. And that generally has to do with, I think, people being uncertain. The big stocks at the top of the S&P 500 tend to attract a lot of money when people are nervous, whereas small cap stocks is not a place people go when they're nervous, and so you get some outperformance in the S&P and the Nasdaq relative to the Russell because of that. All right, S&P 500 versus the equal weight. The 500, it turns out, puts a lot of, right, like if you do it cap weighted, the top 5 companies, which are like Apple, Facebook, Google, Microsoft, those are an outsized portion of the S&P 500 by market cap, whereas if you do the equal weight, you get a look at kind of how all the stocks are doing. So you can see that the regular is the colored line here, and the equal weight's in blue. The equal weight is lagging a little bit, but not as much as it was sort of right at the turn of the year. The Fed minutes last week essentially took some air out of the sails, largely of tech, right? If we go back here and look at this big drop after the start of the year on the Nasdaq versus the big drop on the S&P 500, it was obviously much more meaningful for tech stuff and small cap stuff, and so that's why the equal weight has actually sort of performed a little bit better since January 1 because of that. Those big tech stocks lost more ground than some of the other 495 companies did. All right. Growth versus value. You can see again, growth, which is the red and green line, really took those Fed minutes hard, whereas the value stocks barely reacted. Again, it seems weird that minutes from a meeting that was 3 weeks ago that didn't really seem to change the tone or the expectations. It's interesting to me that everybody seemed to have been surprised by that, but here we are. But it does kind of make sense if the market is suddenly going to react to sort of tighter money going forward, that the air would go out of growth and not out of the value stocks. All right, so Jets versus Apple. Jets is an ETF that just has airline stocks, and Apple is the world's largest corporation. Apple has done better. Again, though, right? We can look at this period after the first of the year and see where Apple has not done as well as Jets. This divergence here is kind of interesting because it was sort of before a lot of the big Omicron announcements, and yet, right, travel stocks you'd expect to go down based on that, and the trade for much of the pandemic is when people are worried about virus, they go to large cap tech. So that's kind of interesting that the market almost seems like it knew a little bit early. But then, yes, since the first of the year, the trend has been reversed a little bit in the sense of, Apple down, whereas Jets is up. All right, Tesla versus Bitcoin. This is an interesting comparison because back here at the beginning of 2021, Tesla did some things like said they were going to start accepting Bitcoin as payment for cars. They then stopped taking Bitcoin as payment for cars. But at that point, the stock and the cryptocurrency were less correlated than they have been more recently. More recently, this correlation has gotten a little bit tighter. Just in terms of, Tesla has a up day, typically Bitcoin has an up day, or if Bitcoin is having a down day, Tesla is typically having a down day. This has to do a lot with expectations of change in monetary conditions. Tesla is, right, like Exhibit A, if you want to talk about growth stocks. Bitcoin is contrary to, I think, what a lot of people would want to tell you in terms of it being like some safe digital asset that resembles gold or something like that. It trades an awful lot like what we call a risk asset, right? Like it moves up and down kind of in correlation with tech stocks and some stuff like that. All right, Nasdaq versus Bitcoin. Obviously, a little bit of this correlation since the start of the year, but much less over the course of 2021 because the Nasdaq as a whole is much less speculative than Tesla, right? Like Tesla is a barely profitable company that trades at an incredibly high valuation, whereas the Nasdaq, even if you just look at the top 100 stocks in the Nasdaq, is a little bit more reasonable. All right, so let's talk about what else is going on. The Federal Reserve and the inflation story are kind of big drivers of stocks. CPI and other inflation data, I think at this point, are probably more important than jobs data. Jobs have been a big driver of markets for the last, really since the recovery from the financial crisis, because that was the yardstick the Fed was using to some degree for a lot of the recovery there. And then the yardstick they were using in terms of how much, how many, rescue programs and things like that on the other side. Whereas with jobs have recovered relatively quickly from the pandemic shock. And so now they're worried about the other side of the mandate, which is the inflation side. And that seems like it's probably closer to being the one to watch for now. You know, I mean, what we learned in December, honestly, was the Fed was wrapping up QE early. A rate hike is possible in March. I think at this point, the market has priced in about 4 hikes this year, which is certainly, I think, one more than the Fed suggested. And those minutes that came out last week didn't really make any hints about the number of hikes. But even then, 4 hikes this year would put, you know, the front end of the curve, shortest term interest rates, at about 1%, because most hikes are going to be about 25 basis points, which is a quarter of a percentage point. So we're not talking about any big move in interest rates from that. The other thing I think that maybe is interesting from the minutes was there was some discussion of bond sales, which would be sort of the opposite of quantitative easing. Right, the Fed has this big balance sheet. After the financial crisis, when they stopped buying bonds, what they ended up doing at a certain point was, right, bonds expire after a time, so they would just kind of run off the balance sheet in that way, right? As the bonds expire, the cash just gets retired at the Treasury. Another thing they could do is actually sell some of those bonds. That would, right, push the prices for bonds down, maybe. That would be kind of the theory. I think that's what people would expect to happen, and that would push interest rates up. As we've seen with QE, though, it doesn't really seem to work that way, in the sense that, right, like the Fed has slowed its bond buying and rates haven't really risen that much. So it's hard to really know the mechanism there. I think really the thing that it does is it signals the Fed is serious about fighting inflation, which is not nothing, because inflation is sort of largely about expectations. And the other thing to remember through all of this, though, is that, right, there's no interest rate that fixes shortages of things like housing and used cars. You know, the CPI came out today. The biggest moves, again, were in housing and used car prices. Some of the other stuff that's been hot recently, like gas prices, actually fell last month. Some meat prices are starting to come down. Inflation is still high, don't get me wrong, but the things that are driving a lot of the increase are things that interest rates aren't going to fix, or are unlikely to fix. Right, like what fixes the used car thing is some relief to the chip shortage that gets new cars back on the market, right? Like essentially what happens is there aren't enough cars in the new car market, so people get pushed to the used car market. There aren't enough cars there, the prices go up. Housing is a similar thing, right? Like we haven't really been building very many houses in this country for a pretty long time, and so yeah, prices go up. That's how that works. Right, so the Fed's trick here is to keep rates and signal that they are serious about fighting inflation without slowing the economy down so much that capital investment by businesses slows. Because what really solves these problems in terms of shortages of goods is capital investment by businesses increases the overall capacity of the economy. That's the preferred way to ease inflation. Right, the other way to ease inflation is just put the brakes on the economy. People have less money, they have less money to buy things, businesses can't charge as much for goods, prices stop going up. That's not really anybody's preferred way to ease inflation. You know, I pulled this quote out from Biden's speech on Friday after the jobs numbers, and he's exactly right here. Right, the important part here is if car prices are too high right now, there are 2 solutions. You increase the supply of cars by making more of them, or you reduce demand for cars by making Americans poorer. That's the choice. This thing of, right, if you raise interest rates too fast, it makes borrowing more expensive. Companies are less interested in borrowing money to expand their capacity. The production of cars doesn't go up as fast, but the employment of auto workers doesn't go up as fast either, so people are less interested in buying cars because they don't have jobs. That's not the preferred way to ease inflation. So that's the kind of tightrope the Fed and other economic policymakers are trying to walk right now. The COVID thing, it's still out there. Omicron is causing a lot of sick time right now, but it does seem to be hitting a peak faster than previous waves, which hopefully means that we'll be over it and past it, and can get back to a more normal set of circumstances in terms of just daily lives and also sort of how the economy functions. All right. What stuff is hot right now? Real estate took the top spot away from the energy sector from 3 weeks ago. And it's residential REITs. We just talked about housing a second ago. And then the next is industrial REITs. This is a lot of stuff like warehouses, some light manufacturing facilities, stuff like that. If you're building an automotive plant, you usually own that. It's not a thing you're going to lease, but light manufacturing, warehousing, storage, various logistical things all get owned by industrial REITs. And then retail REITs, right? Like stores are opening-ish. People are back to shopping, and retail REITs just got really destroyed in the pandemic, so they're still kind of coming back a little bit there. Energy in the second spot, thermal coal, oil and gas exploration, production, and midstream. The coal one here is kind of weird because, most people aren't exposed to the price of coal very much. It's very remote in terms of it shows up in the price of electricity. That's also a very small industry now. So if we had, somehow dollar weighted this, coal probably wouldn't show up there. But yeah, gas prices have been have been higher and rising, and what tends to happen in the energy industry is the price of crude oil will go up, and the price of gasoline and other refined products will go up pretty much at the same rate. And then when the price of crude oil starts to slide, the price of gas doesn't slide quite as fast. That a faster drop in the price of the input than the price of the output leads to higher margins, and so that shows up in the E&P and the midstream as well as on the retail side. Financial services still doing well. The financial data and stock exchanges. So this is right. Stock exchanges are your also options exchanges. So like your CME Group, your Intercontinental Exchange, S&P Global. Companies like that are in this space. That's kind of interesting. It reflects sort of a lot of trading activity, a lot of interest in financial stuff, but it's right. Like what you don't see here is the bulge bracket banks, right? Your JP Morgans, your Goldman Sachs's, because the last quarter I think had significantly less volatility. So there's less trading activity, which is where those companies make a lot of money. Next is regional banks. That's again a sign of a growing economy. Loan origination, just everyday banking sort of stuff are things that people do when the economy is pretty good. So regional banks doing well there. Regional banks also probably make a little more off of interest rate spreads, so you kind of expect that in a rising rate environment. And diversified insurance. This is again kind of hard to tell exactly why they're showing up here, but it's likely has to do again with growing economy. Right, there haven't been a lot of claims paid out. It's like we had a bunch of hurricanes or anything recently, and so it turns out that as people buy houses, start families, open businesses, they need more insurance. Insurance companies tend to do well in that environment. Also, insurance companies make a lot of money from interest rate or from a lot of interest income, so they do well in a rising rate environment there. Utilities, just I think shows people are a little bit wary of certain other things. These things are pretty safe, right? Like there's an awful lot of economic activity that people will cut out of their budgets in a bad economy before they stop paying electric, gas, and water bills. And there's also, these companies tend to pay dividends. They're a decent play for things like that as well. And then industrials, the list from industrials is the shipping and logistics issues writ large, right? Infrastructure operations is companies that operate seaports and airports and that kind of facility. Rental and leasing services includes like big truck rentals, some equipment rental, things like that. So construction equipment or transportation equipment. And industrial distribution, again, is about sort of logistics and some of that stuff. So those are the sectors that are hottest right now. Let me show you where this comes from. You can look at sectors sorted by any of our scores by going to this sector and industry page here. So by overall score, energy, etc. For that particular slide, I use the short-term technical score because it shows you what has been the hottest over the last sort of couple of months. And then here's the top 10 industries here. But yes, you can look at the long-term technical analyst rankings, valuations, sentiment. Any of our stock scores, we got that stuff aggregated and put onto this page here. And then you can drill down. You can click on industrials. You can see all the industries in the industrial sector, rated by whichever one of these metrics you want. If we go back to short-term technical, right, and then here's the top companies rated by those metrics. You can see both this list and the company list change as you change the metrics. All right. This slide is left over from last time. I forgot to take it out. All right, on to the questions. All right, so John said he started investing in stocks 2 years ago, not knowing what an average investor has in terms of number of stocks that they hold. He's done well, currently has about 300 individual stocks and seems to be pretty well diverse. The question is, should I not have so many stocks? What would be normal? Was up to 322, but is trying to get down. Just creating my own mutual fund. Should I just invest in an established one that's already out there? I have 800,000 invested and I'm tired 64. All right, so I mean, yeah, that does seem like a lot. But I think the other piece to think about is, like, certainly the reason that I wouldn't try to recreate an S&P 500 index fund in my own account is, one, I don't have enough money to buy even one share of every stock in the S&P 500. And until a couple years ago, right, like if you're going to pay a $10 commission to buy one share of a $20 stock, that seems kind of silly. So people tended to have fewer stock positions because of that. With zero commissions, that becomes less of an issue. You can buy one share. Some of the brokers now will let you buy like half a share, right? And yeah, at 300, you're probably pretty well diversified. You certainly could sell some and buy an ETF. Granted, selling stocks, depending on what kind of account you're in and various other things, can have some tax consequences if you're sitting on big gains. Right, an ETF, mutual fund, whatever, they're, the fees and some other plumbing things are kind of different, but I tend to buy ETFs over mutual funds just because the fees tend to be lower, and they tend to be a little bit more liquid. But that's a matter of personal preference, I think. I don't really think there is a correct number of stocks. The key is to keep track of what's going on. So try to do some periodic rebalancing. If you have some stocks that have doubled or tripled over the last couple of years, which depending on which stocks you have, I would guess you probably have a few of those. You probably want to sell down some of those positions just because, right, stocks don't go up by 200% every 2 years forever. And then, you tend to that position gets too large, you kind of balance it, rebalance and go back down to buy something else to kind of keep your exposures in line there. And the other thing, the thing that's honestly very difficult about having 300 stocks is, right, like the winners are pretty easy to find, right? But the losers and why they're losing can be a lot harder to find. And so you run the risk of just kind of letting some things underperform because you're not really paying attention. And so, yeah, if you have the time and energy to manage 200 or 300 individual stock positions, that's fine. But but there's no reason. The reason to have that many is, I guess, well, now that you have them, there's some tax consequences to selling. But I wouldn't tell anybody that they needed to get up to 300 individual positions, just because a lot of that stuff can be done with either an index ETF, or if you want active management, you can find mutual funds and things like that to do that as well. All right, so Marcine had a question about insider buying and selling at the turn of the year. She said December, there's a lot of buys and sells by insiders, probably mostly for tax reasons, but most happen after hours. There's a way to capture this activity because she feels like it moves things on the following day. And then she had some examples of stocks that moved. Yeah, so the thing is that insider transactions aren't reported in real time. The SEC rules say that Form 4, which is where most of these things get disclosed, has to be filed within 2 days. So not only are they not filed during trading on the day the trading happens, they may not even be filed on the day that the trading happens. And I think that might even be 2 business days. So if you sell on a Friday, you might not have to, put in a Form 4 until like Tuesday. So yeah, end of year transactions are likely to be tax related. I generally think a better way to use this data is not try to jump on whatever happened, that day, just because you don't know exactly when the sale happened. A better way to use the data is to look for patterns, right? So if you have a bunch of people at a company all selling, or something like that, or large reductions in total holdings, right? So if somebody who gets a bunch of shares at the end of the year, and yeah, the end of the year, there's a lot of things that happen. You have some options that vest, you have, taxes, things like that. There's lots of reasons somebody might be selling. But, if somebody goes from holding a lot of shares and they just, cut their holdings by 90%, that's unlikely to be tax related or something else. That seems like somebody who's trying to shed exposure. So those are the kinds of things that I look for. I don't really try to trade immediately after a buy or sell, just because, you're not ever going to be close enough in terms of the time, given the 1 or 2 day lag. It's just real hard to actually make that a useful trading signal. All right, so Bob said your site provides an ocean of data and information. He's trying to narrow it down to only tech, media, and telecom. Similar questions about options. He wants only covered calls and cash secured puts in the tech sector, and then some stuff about earnings. All right, so let's talk about the filtering first off. So if you go to the stock screener, we have filters for sector and industry. Where did it go? Here it is. Yeah. All right. So if you want tech, now tech, media, and telecom is not one sector. Technology and communication services are going to be some of those. Communication services is kind of a weird mix of stuff like Verizon and AT&T, and then also companies you traditionally think of as media companies like Disney and like Viacom and stuff like that. So you can select those. If you want, you can drill in a little bit further, right? So if you wanted to take out, I don't know, let's say scientific and technical instruments. That doesn't sound like, maybe that's not included in your tech, media, and telecom. Solar maybe isn't included in your tech, media, and telecom. And then we can go to communication services and look and see what's here and be like, well, publishing is maybe a weird one. We can take that one out, and maybe we'll take out gaming, whatever. You can leave them in, you can take them out, whatever your particular sort is. And then, right, then you just have a stock screener, right? So if you're looking for, mega cap stocks, now you've got mega cap filtered by those sectors and industries. So it's only 24 stocks in that group, I guess. Yeah, this page is a little bit short. So, I mean, that's the big way to do it. And then, right, the rest of the screener works the way the screener works. And the same thing happens if you go over to the options screener, right? So obviously all of our option stuff is sorted by strategy. So if you're looking for covered calls, you start there. And then you can go sector and industry and pick, again, communication services and technology. And so that took you down to 616 covered calls from about 3,000. And then, yeah, the rest of the screener functions as it is, right? So if you're looking at covered calls, maybe you don't want a price that's too high. You probably want something in the top half in terms of overall score. Annualized return maybe somewhere around 15%. That's probably pretty low for media and tech, media, and telecom stuff. But and then you can click on the column headers to sort and things like that. If you want to see the highest key rankings, you can click on that one, and it brings those to the top. All right, let's go back to the question. So yeah, that's really how to do that, is just use the screener to filter out the things that you don't want. So yeah, earnings on the option side, there is I think it's a risk management. Yeah. So here you can say trades that will only expire before earnings. You can hit that, and that knocked the number down to 25. If you would prefer to get the extra premium and also take on the extra risk of carrying the position through earnings, you can hit after earnings. The default is just both, but that's one way to deal with earnings. And then the other thing is we do have on the stock pages, price to earnings ratio and actual EPS number. That's for the most recent 12 months is what that EPS number is. And then it's typically the next earnings date is what we have here. If an earnings date hasn't been scheduled, sometimes it's estimated. Sometimes we'll show one in the recent past if it's just a day or two ago. But if you're trying to figure out when, say, this company reported earnings last, well, if they're reporting on January 30th, they probably reported about 90 days prior to January 30th, which would put you at like October. Somewhere in the end of October is where they reported last time, probably about the 30th. A lot of times companies pick the same day of the week. So if January 30th is a Sunday, that's a little bit strange. Yeah, maybe that's the 31st. Then back in October, it may be like the 25th of October or November the 1st, which would have been Mondays at roughly the same spot in the quarter. But yeah, those are the earnings things that we have available there. And then, yeah, you can also look at the stocks to watch. That usually has a list of sort of the weekly highlights as far as earnings go also. All right, I left that one in there twice. All right, so Thomas said, do you use limit orders as opposed to market orders when buying stocks you don't need today? All right, let's do that one first. So you can certainly use limit orders for stocks, right? Like you don't need to put in a market order. You can say, I'll try to catch this at the low of the day and put in some, a limit order at some lower price. That's a fine way to buy a stock kind of at a discount. Put it kind of like just above a support level and kind of wait. The risk there obviously is the stock keeps rising and you never buy it. Missing out on $1 because you're trying to save a nickel is typically a bad trade. But for stocks that kind of bump around and go sideways, you can certainly use limit orders to buy stocks. It's a thing that sometimes I do, sometimes I don't do. It really depends on the situation. For options, I typically always use limit orders just because the bid-ask spread tends to be wider. Right, like if you're looking at a bid-ask spread of a nickel or a dime on a $30 stock, that's not very much in terms of the percentage of the price. Whereas if you're looking at that on a nickel or a dime on an option that's $2 or $3, that's now a massive percentage of the price that you might get, that can change in terms of what you're paying or receiving for buying or selling the option. So I tend to always use limit orders for options, particularly to open. If you're closing an option position, sometimes you just want to get out. So occasionally I'll use a market order there, but even then, not particularly often. And then explain stop and stop limit orders. Yeah, so stop and stop limit orders really kind of depend on your strategy, right? Like for long-term buy and hold investors, I typically, I don't have any stops or stop limits, right? More likely is if it's a stock that I still like, I'll buy more when it's lower. It does make more sense for swing and other short-term traders, but even then, you end up with some weird risks in terms of it's possible to be stopped out by some small amount on a dip. We had a swing trading product here for a while, and some of the frustrations were a stock would go down and basically hit our stop and then shoot right back up, or go through our stop by 3 or 4 cents and then shoot right back up. And so then it's like, oh, well, I just should have made my stop a little bit lower. But 3 or 4, I should have made my stops a little bit lower, and now your stop is really wide. So now every time the stock goes down, you're just taking a bigger and bigger loss with every dip. So it really kind of depends on what kind of trading you're doing and sort of what your method is and your how you want to sort of be disciplined about things. So the difference between those two is a stop is triggered when a price level is breached. So if you have a stock and you have a stop at $10, if the stock goes below $10, the shares will be sold. So if you wake up and the stock opens at 5, all your shares get sold, but they get sold at $5, which is not great. A stop limit combines the stop order with a limit. So you can say, stop limit at $10, and then if the stock trades at $10, your shares will go. But if the stock opens at 5, the order won't be filled. And what this saves you from is, sometimes stocks just gap lower at the open and then come back up, or they have a big dip intraday on low liquidity or something like that. And so that will save you from some potentially big unnecessary losses while still attempting to get you out, at the level that you've determined you no longer want to own the stock. That's the last of the pre-submitted questions. Thank you to those who submitted those. All right, so we have a question in here from Zaid, who, all right. It looks like this is a question about an IK trade, so I'm going to go find the trade here. So Investors Keyhole service is part of the Elite Options package. We send out, among other things, 4 trades a day that are typically bull put credit spreads. So in this case, the trade was from the Insider Activity Report. And so the question is, this is the actual trade piece, right? So the technicals are bullish with an upward trend. The stock has support at 57.83. It's trading today at 67.64. Look at the February 52.50 bull put spread for at least a 30-cent credit. So this is really the trade right here. The February 50-52 bull put spread for a 30-cent credit means you're going to sell the 52.50, the February 52.50 put, and at the same time buy the February 50 put for a net credit, right? You bring money in from selling the 52.50, pay money out from buying the 50. And so the net difference there should be 30 cents. This is another case where you want to use a limit order. It's a limit credit order in options. And so that means that if it trades at 31, right, 30, 31, any price better than 30, you'll get filled there. But you know, at 15 cents, this trade you don't want, right? So you set the limit at 30 and you get filled for 30 or better, but no worse. And then, yeah, this trade manages to have a target return of 13.64 because the most you can lose on this trade is $2.50 a share, which is the difference in strike prices here. But you also got 30 cents up front. So really your out-of-pocket loss, the biggest it can be is $2.20, which is $220. So if you have $220 at risk, and you're looking at a $30 per contract profit, that is how you get to 1364. And yeah, the stock was at 67.64, and your break even is a little below 52.50, so that's where that 22.38 comes from. Yeah, and there are, like I said, 4 of those a day. You can get them by email. They're also under Investors Keyhole on the options dashboard, and they are insider activity, usually one that's just based on the news of the day, one that's based on an upgrade or downgrade, and then one that is based on unusual options activity. We try to find a big trade and explain it to you, and then put on a trade that runs in the same direction. All right, so yeah, that's that. What else do we have in terms of questions? All right, so while I'm waiting to see if anybody else has any more questions, I will say that, yeah, this session, like all of our webinars, is being recorded. We'll post the recording and a copy of the slides tomorrow, and we'll send you an email, but it'll also show up on the news homepage. You can find old workshops by looking under personal finance. Looks like there's some missing there, but yeah, most of them show up here. I'll see what I can do. It looks like the last couple might be missing, but they should be around here somewhere. All right, so Jim says, do you provide follow-up guidance to featured trades or the Investors Keyhole trades? We don't for those. Follow-up guidance is available for the options portfolios. We have 2 positions currently open there. We tend to normally have more open, but between the holidays and some volatility, we just haven't really found anything that we liked, and we'd rather publish trades we feel good about than publish trades to say we published some number of trades. So that's really what's going on there. But yeah, the a lot of that stuff, there's just so many trades, we're not really able to manage them. So if you want managed stuff, it's in the portfolios. But the IK and feature trades and anything in the screener, those are sort of on your own to manage. Van, I'm not 100% sure I understand your question, which is, can we get more access to the site using the mobile app? All the stock stuff is available in the mobile app. We're talking about what else to add to it. We're also currently working on an Android app. That's going to be the next development in the app world, which is no gain for iOS users, but right? Everybody who has an Android, yeah, just doesn't currently have any kind of app. So yeah, the option stuff we would probably put in all together as opposed to doing it in bits and pieces, like just adding the investor's keyhole. Those are available by email, which most people have email on their phone. So that's, we kind of look at that as a way to make it at least kind of mobile compatible or friendly, as you can get that notification and it shows up. You can read it on your phone without having to go to the website. And yeah, like I said, development is a constantly ongoing process. We will probably get there eventually. It's just a question of when, but that one's not happening soon. All right. One other thing we have added, possibly since the last time we talked, is this star. This star will let you, it's on, I think, a couple of the dashboard pages, right? So here's the options dashboard. Here's the stock dashboard. I don't think it shows up on the individual stock pages. No. Okay. Yeah, so if you see that star and it's filled in, that is the page that you will be redirected to automatically if you stay logged in your browser and you just come to the Investors Observer website. If you decide you want to change it, you can just click that. So options dashboard is now your preferred homepage. It's that easy. You can also get to it under the the My Account. You can adjust it there as well. All right, not a ton of questions this time. I'll hang out for a few more minutes, but yeah. I'm not sure I understand what you mean by does the options dashboard get updated? Different parts of it get updated at different times. So there's new trades over here every market day. News comes in as it's published. So, anytime there's news on one of the stocks in one of the option portfolios, it shows up here. Morning update gets, a new morning update every market day. The investor's keyhole gets updated. That section gets updated 4 times a day. Yeah, those are probably about the newest trades. Yeah, I guess the one is from 12/9. Yeah, those are the newest trades. The sold legs have expired there. Citi is reporting earnings Friday, so yeah, we'll probably do something with that pretty soon. Blackstone Group is probably not far behind in terms of earnings, so be on the lookout for updates about those if you're following them. And also, new trades are hopefully coming soon. Probably after we get a few more companies reporting earnings, we'll start looking at stuff from that group. But yeah, those tend to come out at the end of the day, and you can place the order for trading the next day, whereas exiting positions we tend to do during the day just because that's really the best way to do it. But it does mean you have to be able to react a little bit quicker as opposed to, just get this email sometime between 4 and 5 p.m. and do something with it before 9:30 a.m. the next day. All right, well, if there's no more questions, I'm going to go ahead and sign off here. If there are questions, send them in quickly. Yeah, like I said, recorded. We'll send out a link tomorrow. You can get in touch with us anytime by hitting this help button and sending us an email. We get back to most of those pretty quickly. If it's something you'd like to see some slides or some longer discussion about in a workshop, by all means, let us know. But we're happy to answer questions about things, more than once every 3 weeks. Just, shoot us an email and we will get back to it. Yeah. All right. Well, if that is it, then thank you all for coming. Thank you for subscribing to Investors Observer. And yeah, I'll talk to you again in about 3 weeks. Thank you.